Now, one of the ways to adjust your portfolio is to get P.A.I.D from real estate, but you must do it intelligently. And the intelligent way to invest in real estate these days in this market is buying through real estate investment trusts, commonly known as REITs. So, if you're looking to get P.A.I.D from real estate in the intelligent manner, in the clever way, in the manner in which the uber wealthy get P.A.I.D, please take copious notes. Now, if you're a big yield hunter, it's difficult to determine ahead of time which high-income investments can turn around to maul you. It brings to mind a line from a noted comedian who said, quote, "Experience is something you don't get until just after you need it," end quote. Now, hindsight often makes tough decisions seem simple or obvious. While we know that markets eventually rebound, we don't know when it will finally happen or how much longer the companies hit hardest during the downturns can endure if the situation gets even worse. Now, I want to bring to your attention a dividend player with unique characteristics that should hold it steady during the market's pending downturn. Okay? This real estate investment trust also is a play on His Royal Highness Donald Trump's repeat and his vow to stem illegal immigration. Now, whether you agree or disagree with His Royal Highness Donald Trump and his hardline immigration stance, okay, his proposed border crackdown is a fact of life that's unfolding with greater urgency each and every day. Now, analysts tend to focus on Trump's promise to boost defense and infrastructure spending or to reduce taxes and banking regulations, but little attention is paid to the money-making potential of the federal government's greatest and greater push for immigration enforcement. Listen to me closely and take copious notes. Now, first, let me explain why REITs overall makes sense for traders and investors, or more specifically investors who seek a steady stream of income. You see, as the Federal Reserve continues to tighten, conventional wisdom says that higher interest rates are bad for real estate investment trusts, but that this particular asset class is holding its own. Year to date, REIT-intensive ETFs like the iShares U.S. Real Estate ETF, which trades under the symbol IYR, that's IYR. Well, that particular macro position is up nearly 7% compared to nearly 10% for the S&P 500. But rather than obsessing about the Fed's next move and letting it dissuade you from putting money into REITs, you're better off focusing on the stock's quality and long-term prospects. REITs, you see, real estate investment trusts, are all-weather, and they are all-weather total return investments. Although the occasional bust from a financial crisis does indeed happen, real estate investments trusts generally hold their value in a down market because the rents their tenants pay are controlled and contractual obligations. Rents also tend to rise with inflation, helping offset its corrosive impact on purchasing power. So you see, when you're considering real estate investment trusts, look for those that are consistently growing their funds from operations. That's called FFO, Fund from Operations, which is how REITs reports earnings. Now, because FFO, once again, what? Funds from Operations, doesn't include gains or losses on property sales, nor depreciation, the metric gives you an idea of how a REIT is faring on a real cash basis. And we need to know that. Okay, you also want REITs that are in stable markets where rents aren't falling and vacancy rates aren't high. Those REITs, you see, can create FFO and FFO growth by steadily raising their rents without scaring off tenants. Plus, they're more recessionary resistant because tenants know that they have a good deal. Now, the REIT's management team also is an important consideration. Is there a steady deal flow as management reinvests available cash? Or is the team resting on its past laurels? Now, when the management has demonstrated a consistent track record for us of profitable deals, then our money is indeed in good hands. Now, one particular REIT that fits all of the criteria I just mentioned is Easterly Government Properties. Once again, Easterly Government Properties. It trades under the symbol DEA. D as in Delta, E as in Echo, A as in Alpha, DEA. Now, U.S. government agencies lease most of their space in Easterly Properties ETF, symbol DEA. So this particular position, DEA, is a safe bet that REIT leaseholders will stick around, regardless of economic ups and downs. Now, with Uncle Sam as the tenant, DEA is a crash-proof haven amidst a risky and overvalued broader market for you, me, we, the Ask the Wiz Wealth Institute family to get P.A.I.D. from. That's especially true now that the FBI and Immigration and Customs Enforcement, aka ICE, are DEA's main tenants, accounting for about a quarter of the REIT's income. Now, because of these tenants' security concerns, their space must be designed to strict specifications, which means they can't just move on a whim. Now, with a market cap of $958.6 million, DEA focuses primarily on the acquisition, development, and management of Class A commercial properties that are leased to the U.S. government and U.S. government agencies through the General Service Administration. Now, all of the REIT's properties are currently leased for 7-year terms. I said all, not some. 100% occupancy for the DEA properties currently exist. And these particular tenants are on the hook for 7-year terms. Now, DEA, talking about that Easterly Government Properties, owns 44 properties that consist of about 3.2 million square feet. Now, the majority of DEA's buildings are office buildings at 75%, and the rest are mostly laboratories and courthouses. Now, this particular ETF, once again, we're talking about DEA, is based in Washington, D.C., and it was founded in 2011. Now, DEA's management has been turning in solid FFO growth through a series of property acquisitions. Most of those properties were already occupied by law enforcement agencies, while the rest were owned by some other government agencies. Now, given that track record of successful acquisitions and the government's preference of leasing rather than buying space, it's likely that management will continue finding profitable deals for DEA. Now, DEA is the only internally managed REIT with a focus on investing in U.S. government-leased buildings. I repeat, DEA is the only internally managed REIT, real estate investment trust, with a focus on investing in U.S. government-leased buildings. Family members and listeners alike, that's a rock-solid business model because the United States government is the largest employer in the world and the largest office tenant in the country. Now, at the end of the day, analysts expect DEA will rack up year-over-year earnings growth of 63.6% in the current year and 22.2% next year. And get a load of this. DEA also pays us a dividend at 4.76%. DEA, they get you P.A.I.D.